Happy New Year, everybody. It's the year 2020. Today's New Year's Day when this episode is airing. And we wanted to do something new. We're giving a little teaser clip before each episode begins with our guests. We thought that'd be kind of fun to do for you guys. So you get a little feel for our next guest before I read his bio. And what a guest we have this week. Super excited. Today we have on Dror Poleg. He is the author of Rethinking Real Estate. And the book just came out in November. Please check it out. You could go to his website or you can go on Amazon. He was sweet enough to mail me a free copy, which we talk about in this episode. And I have since received the book. I can't put it down. It's incredible, talking about just the shift in real estate, which is the world's largest asset class. I'm sure he poured so much work into this book. You could just tell how well written it is. He is on today's episode. Such a great guy. He is also the co-chair of the Urban Land Institute's Technology and Innovation Council in New York. He is a former real estate and technology executive who now dedicates his time to researching the impact of technology on urban life and the way physical assets are designed, used, and valued. And Dror advises executives across the real estate universe on emerging business models and consumer behaviors. His clients include multi-billion-dollar companies such as AvalonBay Communities, British Land, Liberty Mutual, Dubai Holding, and Cushman Wakefield. Industry organizations such as the National Multifamily Housing Council, NAIOP, EPRA, and INREV. Tons of acronyms there, as well as venture-backed startups such as Breather, Bumblebee Spaces, and Carson. And Dror's work draws on his experiences living and working in some of the world's most vibrant cities: Paris, London, Tel Aviv, Beijing, Melbourne, and New York, as well as his formal training at the London School of Economics, INSEAD, and Swinburne University of Technology. His insights and research have been featured in reports and events by Moody's, KPMG, PwC, the Royal Institute of Chartered Surveyors, Business Insider, Forbes, The Real Deal, PERE, Cheddar TV, CRE Tech, MIPIM, Real Estate Weekly, and Estates Gazette. And previously, Dror served as vice president of Carson Land, where he oversaw the expansion of a $3 billion property portfolio in partnerships with investors such as BlackRock, MGPA, and Fraser's Properties, and also as CEO of Others.com, an app development company, and head of digital at Standards Group, a creative agency that served clients such as IKEA, Scandinavian Airlines, and Shangri-La Hotels. So Dror has a super impressive resume. We both spoke on the same stage over in Finland a few months back, and it's so great to bring him on the show this week for you guys. I know you're going to love it. Ooh, and one last thing that we actually mentioned on this show, and I really wanted to tell you guys, and I've been keeping it a secret. We are actually going to launch a separate show where we will specifically be talking to people in the prop tech world, property technologies, which is a very vast category. And there's a ton of overlap when it comes to property technology and co-living. And, obviously I want the co-living show to, we touch on tech, but we don't go deep on tech. So for all our fans and friends that want to go deeper on the technology side of the conversations, those will be the guests we bring on Fridays to talk about those cool, innovative things that are right around the corner in technology and co-living. So stay tuned for that. We'll start airing it in a couple months. And our next guest, Dror, already gave me his word. He's going to come back on to talk specifically just about technology on another future episode. But you guys are going to love this one. Like, he's just so insightful. I enjoy this week's episode with Dror Poleg, author of Rethinking Real Estate. Hello, everybody. Welcome to another weekly episode of the Co-Living Code Show. Christine here with our next guest for this week, Dror Poleg. He is the author of Rethinking Real Estate. And this book actually just came out in November. Hopefully you guys have seen it. If not, definitely grab a copy. He is one of my favorite writers. Yes. Show the book, please. I love it. Okay, so his posts on LinkedIn and on his blog are incredible, especially the WeWork ones, right? I mean, obviously they're always in the news, but I agree with a lot of this stuff, the way you look at the business model. So we are going to go deep, deep, deep in this conversation about co-living and just, you've lived around the world. So definitely let's start there, Dror. Thank you so much for coming on. So let's start your background and all the amazing cities you've lived in.
So first, thank you for having me, Christine, and I'm glad to meet in person. I think we crossed paths in Finland a couple of weeks ago, but didn't get to talk directly. So yeah, I was born in Israel, spent some of my childhood in Paris, France, then traveled around the world. When I was 21, decided to stay in Australia for a few years, so lived in Melbourne. From there, it was a little too nice, too quiet, too pleasant, too perfect. And I wanted to go somewhere a little rougher and crazier, and somewhere that needed that needed a lot more that needed people to come and build new things. So I moved to China, to Beijing, and spent almost a decade there doing real estate development. In the middle of that decade, I took a break and went to London for a year and did my master's there. And these days I'm based in New York. So yeah, I've lived in all sorts of large cities. I spent also long periods in Bangkok and in Tokyo. So a big city lover and kind of experience all sorts of things that people are building and ways to live and work.
And you went to the London School of Economics, right? When you're in London?
I did, yes.
Nice. Okay, great. So yeah, let's start just on a macro level of co-living and just, again, I know you have a deep, deep knowledge of real estate across all sectors. Like, what are your initial thoughts, how fast it grew or just, where it's going?
So I think, co-living, it's inevitable that it will continue to grow. And I think that the most interesting thing about it for me, I'm not a co-living operator, I'm kind of someone looking at the industry as a whole, is that I think co-living and the co-living companies are really precursors for the transformations of the residential market as a whole. Emergence of these branded, serviced, furnished operators that are focused on specific demographics and on people with specific needs. And we're starting to see those seeds blooming and moving up market already. So companies that started as, focusing on these, let's say, the lower end of the market and the customers that a traditional landlord doesn't want to deal with, such as people that, live with roommates or live in like not the best neighborhoods, but kind of up and coming neighborhoods. We're starting to see some of these companies now coming out with different brands and with new offerings that actually cater to different types of consumers, to families with kids and kind of more upper middle class, different parts of the city. So really starting to clash more directly with the traditional multifamily products. So for me, that's the most interesting thing about it. And I think that we're just getting started. I think that over the next 10 years, more of the residential market will be transformed to be operated by companies such as the ones that are currently seen as co-living companies, but we'll have to find a new name for them probably at some point.
I know, right? And you brought up a good point, because remember, it was like if you did call a landlord that owned a big, beautiful home and you said, hey, it's a bunch of roommates living together that want to rent, they kind of were like, oh no, too much risk, too much.
Yeah, wouldn't even be, oh no, but they would just say, I don't care, whatever, just come to me when you're all together and you agree on a date and you all have money for your deposit and sign the lease. Like, I don't care how many of you there are. I'm not going to deal with the coordination. I'm not going to help you find each other. I'm not going to help you vet each other. I'm not going to help you enforce who's supposed to pay the bills or, who's supposed to clean the bathroom. It's all your problem. So there was a gap in the market in terms of what the customers needed and what landlords were willing to provide. And the co-living companies, just like the co-working companies, stepped into that gap and are filling it, but they're still figuring out what is the best way to fill it in terms of how to finance it. It's clear that the customers want it. It's not yet clear what is the right business model and how to really pay for all of those services.
And then that leads to my next question is we kind of see a similar model starting to appear, similar to the hotels, right? Because I know there's about, I always usually talk about the top three, but I know you've talked about 5 on how, hotels secure their inventory.
Yeah.
Can you go over each one? And I think all 5 would actually cross over to co-living too, right?
Yeah, well, I hope I remember them. But the first one, the easiest one is just to come in and sign a lease, so to come to the landlord, sign a lease for a whole building or for a bunch of units, and then operate them under your own brand. The second one is to acquire a whole building. The third one what was the third one? The third one, I think, is the third and the fourth are franchise agreements or management agreements. So coming to the landlord and assuming that the landlord values the co-living operator and thinks that he needs that operator, the landlord would be willing to forfeit the rent and to kind of reach some sort of agreement where they share the revenue. And the fifth one is what we call a sandwich lease, which happens in some hotels, which means that the landlord is only interested in someone signing an actual traditional lease. The co-living operator or hotel operator doesn't want to sign a lease, but there's a third party that says, I can actually sign that lease. I get a discount because I sign, I buy in bulk, basically. I sign a lease for the whole building for many years. And then I go and get a piece of the revenue of the hotel company. And unlike the landlord, I'm actually comfortable with that risk because I think I can make much more money than the landlord will just by collecting, the base rent. I can actually collect a piece of the upside and a piece of the operating profits of this hotel or co-living or co-working company for many years. So on paper, these are the models that are prevalent in the hotel industry. In North America, most large hotel companies use franchise agreements and operating and management agreements. So they don't sign leases. They don't own most of their buildings. In Europe, leasing hotels is much more common for hotel companies. But even there, leasing sometimes means something that involves some revenue sharing, some base rent, and then revenue sharing. So it's a spectrum. It's not so clear cut. So these models are all relevant to these new operators that are coming to office and residential.
And so is there a model? Because, I think of these co-living operators are finding their way. And some have been in operation since 2012, 2016. So they've got a couple years under their belt. Like, is there, just from you outside looking in, is there some more profitable ways you think that's more long-term play?
So I think co-living companies have actually been smarter than the co-working companies. So WeWork has grown very, very quickly. And one of the reasons it has grown quickly is because it's easier to grow quickly in the office market. You can lease really large chunks of space. There's much less regulation about what you're allowed or not allowed to do with the space. If WeWork takes an empty floor, they can put walls almost wherever they want, as long as it's not a fire hazard. But when you buy, an apartment, it's much, much, much harder to start moving around walls and eliminating kitchens. And it's much more heavily regulated, which means that you have to grow more slowly. And I think that actually, now we understand, worked to the advantage of the co-living companies, because some of them have grown very nicely, but they haven't grown, at WeWork pace. And what that meant is that they were also a little more patient, a little more discerning in their expansion, but also they didn't rely solely on venture capital like WeWork did. So when you rely on venture capital, you basically, you get money even if you're losing money and even if your plans are not very clear. But that money requires you to grow very, very, very quickly and to not be discerning in terms of how you select locations. Now, co-living companies from very early on started experimenting with other ways to finance their inventory. So some of them have, I think, let's say a company like Common or like Ollie, both of them started almost from day one in partnerships with developers or with people that were willing to, buy a building or at least let them play with a piece of their building in order to experiment. So they didn't necessarily have to come in and lease a whole building before they even knew what they were doing. Even if they had to lease the building, it's a much smaller building. So I think in Common's case, they started in these walk-ups here in Brooklyn, which, are 5 apartments or 6 apartments. So nothing crazy, not like we were coming in and taking 35,000 square feet in the middle of Manhattan. Like, taking 5 apartments in like eastern part of Brooklyn is, it's a bet that, even if you lose, you still have enough cash in your pocket to try again a few times and to figure out your model. So, one way that they do it is, they partner with people who are more open-minded and are willing to really either buy a building for them to use, and then they spend some of the money on the renovation of the building, or people that own the building but are willing to share some of the revenue, or again, people that still require them to sign a lease, but it's a much smaller lease, so it's less dangerous. But what we've seen over the last year and a half, and I think especially in the last 6 months or so, is that companies such as Common, such as Ollie, such as Star City, such as the Medici Group, which run Quarters, which is another big brand, have started to really create their own capital markets departments, which means that they go and they find investors that are looking to buy real estate that will be used by these operators. So they're not going to venture capital investors and tell them, hey, just give money to my company and I'll do whatever I want with it. They're going to people who don't want to invest in a startup, to people that just want to buy a building and tell them, hey, you buy the building, you own the asset, so you have that real estate exposure, which you're comfortable with, and we will operate it. You just kind of help us by, being our landlord and being a little nicer to us than some other guy who's never heard about us. Plus, if we're lucky and you're doing well, we might even take a little piece of your real estate profits because we helped you find this deal and we helped you manage this building and reposition it and turn it into such a great asset. So I think this model longer term is much more viable. It makes more sense because it's not so different from the traditional real estate ownership model. But yeah, in WeWork's case, it would have been a little more difficult to try to do that from day one, but we can leave that to a different podcast, I guess.
Yes. And again, I mean, everybody on this show knows I'm a huge WeWork fan,
Mm-hmm.
Even still, what they did to co-working to the industry and
Yeah.
just made it mainstream is so impressive. And it is nice to see, I guess, SoftBank is coming in and tightening the reins, right?
Yeah.
I just read another company that
I saw, with Spacious. So
yes.
I'm in a WeWork right now. I took a temporary WeWork because we just had a baby and I wanted to have an office walking distance from home. And, I had a nice budget, but no one would give me what I want. WeWork was the only company to actually accommodate someone like me. But yeah, I hope they don't cut things too strictly because we still need the lights to run and some water.
But just that core product, right? Like if they shrink it back down to the core offering of an amazing, consistent office experience that's month to month, that you don't have to sign a 3-5 year lease to have office space.
I'm a big fan, and I'm a fan of anyone who's trying to do something interesting in this industry. So I want them to succeed. They're very important, and they can help so many other smaller companies. If they do well, they can buy other companies, they can invest in other companies, they can contribute their executives when, to be like PayPal or like those companies that spawn other companies and have great executives that learn something and then go and build other great things. So the real estate industry needs more companies like WeWork.
And then how closely did you watch the We Live, kind of branch off, start? Like, what are your thoughts? And I know a lot too about, how they branched off.
I watched it actually.
Too hard?
I watched it pretty closely. I think as soon as they got started, I went and looked at the building, and then I kind of did some mystery tours at the one in downtown Manhattan, and I know various people who worked there over the years. And from the beginning, I didn't think it's going to be a winner. I even wrote about it a little bit, I think 2 or 3 years ago. One, I just thought that it's a lack of focus. I thought that office, the opportunity is so vast. You don't need to start diversifying into all sorts of other products. Second, residential is more complicated than office in many ways, as I said. So, I mean, if you diversify into something that is really like figuring out everything else from scratch, different regulation, different landlords, different customer needs, it just didn't seem necessary. And then their product itself seemed like they were trying to reinvent the wheel instead of looking at how people are living and trying to make their lives a little easier within that framework. So a company like Common here in Brooklyn, they went to buildings that people were sharing anyway. They went to people that were looking to share anyway. They went to landlords that have roommates within their buildings anyway. And they just said, hey, all of you guys are suffering. We're just going to streamline all of this and, hopefully we'll make money as well. What WeWork did, they said, let's take an office building in downtown Manhattan, turn it into like a whole new thing where people, one guy sleeps inside a court, like inside the wall, another guy has a normal bed, and it's like a 250 square foot unit, and convince them that they're happy to live there. And each one of them will pay, $1,500, which is like what they would pay in East Village or somewhere else. But what ended up happening is because the layout was so radical and because the location, it wasn't a terrible location, but it's just not where these kind of people live. It ended up being a product that actually one person stays in that unit. So it's not for 2 people. So it's for one person that pays $3,000 for a studio, which in New York, you can sell anything. But if you're selling a studio for $3,000, you're not really solving anyone's problem. So yeah, So, I
Yeah,
mean,
no, and I've toured.
yeah.
A couple years back, I did
Mhm.
tour that building, the exact one you're talking about. And yeah, there wasn't there's beautiful common areas, and it had the WeWork look and
Yeah.
feel, but nobody was in the common spaces. People weren't interacting. You're exactly right. It's the part of town it's in. It was the way, it's in a high rise, and that is a little pricey, right? So
Yeah, it doesn't feel like living in New York in many ways. It's not a walkable kind of area too much. It's walkable enough because it's in New York, but it's not like you go downstairs, you're in the middle of an office kind of precinct. The streets are wide.
yeah.
You walk into an office building when you come home. It's not really a great vibe. That's not what people come to New York for.
Yeah, no, and you're right. It was very different. It was a very different environment. And again, but you're right. It's and I've talked to the execs there in the
Mhm.
We Live department side of
Yeah,
things, and yeah, they were just like, "Oh my gosh, it's completely different than desks. It's
yeah,
like actual people living there,
right.
24/7, and it's just a completely different product and difficult. I mean, I think a co-living home could switch to co-working because it'd be
Yeah,
easier, tack it on. But when you flip
yeah.
the
But I
other,
mean, both of them. There's plenty to do just by diving into each of these. I don't think these companies need to try to be more than what they are. I mean,
exactly.
both the co-living and co-working companies, they have enough room to grow and enough problems to solve in their own backyards.
And then again, some of the larger operators here in the States, what
Hmm.
I hear they're doing, they've got a pipeline of like 12,000 coming
Yeah,
out, but then they're saying, well, hey, out of that pipeline, about 50% is considered our co-living product.
yeah,
The other is like a multifamily. So now it's
yeah,
almost like they're reinventing multifamily, right?
yeah.
Property
So
management.
I think part of something I cover in the book, so there's chapters about retail and office and industrial and residential. And each chapter starts with a bit of history about why are things even the way they are, and all the things that we take for granted, should we take them for granted, or are they kind of new as well, and how are they shaped by technology? And what we see in the residential chapter is that hotels and apartment buildings have a very common history. I mean, and 150 years ago it was very hard to tell the difference between one and another. There wasn't a clear definition. And even in a glorious city like New York, by up to 860, they weren't really proper apartment buildings. They were like these mansions for rich people who lived, in huge houses. Then there were houses like this that were converted into tenements. So, they were like for poor people or for working people, but they were not designed for those people. They were just rich people's homes that were converted. And then there were actual hotels, and hotels could be very cheap ones, so like lodging homes for workers, or they could be something like the Waldorf Astoria or the Plaza or other famous buildings in New York. And in those hotels, the wealthy families that were willing to not live in a large home of their own actually stayed for months or for years or for decades sometimes, but it was still a hotel. And then gradually, in the 1860s, the first kind of multi-family apartments started to emerge in New York, following stuff that was happening mostly in Paris a few decades earlier. And what's interesting about that is that as they emerged, the criticisms that people had towards them were very similar to what people say today about co-living. So, I mean, the idea of sharing even a staircase or a lobby with someone else was like, was immoral and unchristian, and kind of, how would you let your wife walk down the stairs when someone else might come up the stairs at the same time? Or, what kind of frivolous people would live in such a building? But gradually it became very normal. And, for us today, living in an apartment building doesn't seem like a radical kind of social experiment. But 160 years ago, it was. And I think with co-living, we're starting to see the same kind of maturation of public perceptions. And I think it's even easier because people have lived with roommates since forever. It's not that the co-living companies have invented the idea of sharing an apartment. They just made it a little easier. But more importantly, the boundaries between what is co-living and what is multifamily, and even what is a hotel and what is an Airbnb, are starting to blur. And all of these companies are converging into the same place, which is, service branded residential real estate. And I think ultimately many buildings and many companies will offer a spectrum of solutions. There will not be co-living companies or hotel companies. I mean, there'll be some hotel companies, but many buildings would kind of offer a bit of everything, something, a short-term solution, a shared solution, a furnished, a non-furnished. And it will be completely normal, as it should be, because that's how people live. And what the landlord thinks the building is doesn't really matter. What matters is what people actually need. So yeah.
No, no, I love that. I love that answer. And so, so it seems like what are your thoughts, again, how technology is playing a role?
Hmm.
And for everybody listening and watching, we're launching a weekly, which Dror already promised he'll come back on separately, where we can only talk about real estate technologies.
Uh-huh.
It's like we could totally dork out for a whole nother episode.
Yeah.
So we're launching a separate prop tech weekly show.
Hmm.
So we'll go deep, deep, deep into tech. But like on a macro level, what are your thoughts about all these aggregators,
Hmm.
right? And all these platforms that are now and especially in New York, especially where you're
Yeah.
at, they're pulling all the vacancies, they're
Hmm.
listing them on one platform. A lot of companies are kind of jumping into that.
Hmm.
So that's one part of my question. Second part is, do you think, again, now with all these shifts in how we're accessing real estate, is it going to be the brand that really stands out, the brand of the
Hmm.
company or the ethos or the community?
Yeah. So I think, I mean, technology is pushing these trends in a few different ways. One, outside of real estate completely, just in the way it changes how people work and how people buy stuff and the choices that people can make today about where to live and how to go to work and, how to get the stuff that they need. It opens up many more options for them often. Second, it, even without creating any new supply, it makes the existing supply much easier to find and to access and to book, which means that landlords face much more competition. Because if in the past, I would come and spend a day with a broker or 2 days, how many apartments can I see in a day? Today, I can see 100 apartments in a day, which means the market is much more liquid and landlords have to do much more in order to stand out. And also the way marketing, online marketing is built, if you want to have a relatively low customer acquisition cost, you have to be more focused on a specific customer and communicate to them. So it's not enough to just list whatever you want for everyone and spend a lot of money, because it's not going to work. So there's basically, landlords are finding a need to specialize and to focus on specific customers. Uh, Now, in terms of the aggregators, I think we'll see a bit of everything. So if we look back at the hotel industry again, so you have these online travel agents that are extremely powerful, but you also have the hotel brands, which are extremely powerful. And then you have independent hotels that kind of partner with the online travel agents because they enable them to like distribute their product and their inventory to people that maybe in the past a small hotel couldn't reach. So I think we're going to see a mix of different things. Some sort of balance of power will emerge as we have today in the hotel industry. But we're definitely going to see more brands becoming important. So I think Common, they like to say that they have, I think, 50,000 new leads every month of people that just come to their own website and, want to live in a Common building. And through their own digital brand and kind of booking platform and kind of discovery platform, they're able to put more people into apartments. And I think in hospitality, we see that as well. So, I mean, a company like Sonder, which really started just as a bunch of people that furnished apartments and put them on Airbnb, gradually they're getting more and more of the demand directly on their website. So they're still reliant on Airbnb and on Expedia and on Booking.com. But I think 20 or 30%, I would estimate, of the people actually type Sonder.com or go and look for their specific product because the brand is becoming more important and more recognizable. So, I mean, to answer your question, I think we're going to see a mix of everything, like more of everything and less of the kind of old way of doing things with the brokers and traditional landlords.
And then, no, and I love that. And actually, a good friend of mine, we were just chatting just the other evening
Mm-hmm.
about what about rewards points? If
Uh-huh.
people are jumping
Yeah.
residential, kind of like hotels and
Yeah.
airplanes, do you see that in the near future of like trying to get that brand loyalty by using a rewards program?
Yeah, I definitely see that. I think it's relevant and it will become more prevalent. I know that some large landlords today already, even not co-living landlords, like a company like, let's say, Equity Residential, uh, they first allow you to move within their portfolio. Like if you're not happy with your apartment, they allow you to, switch to a different apartment, assuming that it's available, even in a different project. And I think they have this thing where you accumulate some stuff and then you get discounts on your second year if you go to a different project. So I don't think it's not as robust and as exciting as like a Marriott Rewards program. But we definitely see the seeds of these things. And yeah, I think as the market becomes more competitive and as brands become more important, we'll see more of those hotel type activities happening in the residential market.
And then do you see like the gray stars of the world, like these big,
Hmm.
massive, and I know PMG already jumped into co-living,
Yeah,
a few years back. Do you
yeah.
see other ones following suit where they spin off another brands for co-living?
I do. I think some of them have been trying kind of, very slowly and gently to experiment. I mean, even AvalonBay, they kind of launched one or two smaller brands, not really co-living, but kind of a little younger, a little cooler, speaking a different language, different website. But they're doing it very slowly. I mean, these companies, first, they're not doing too badly now, so I don't think they feel like, an
With
immense need to change. And
high occupancy rates.
yeah, and when the market softens a little, they might feel, they might become a little more open-minded. They do realize that something is happening, but the fact that where we started this interview, that these co-living companies on the demand side, it's clear that people want it, but on the business side, it's not clear that it can be profitable in the way it's currently funded. And I think that's helping existing landlords to kind of delay any decision. They're like, okay, it sounds cool, but it's losing money. I'm making money in my current model. Why do I need to try even anything else? But we're seeing some of them partnering with the co-living companies and kind of bringing them in, giving them a few units or a few floors. Uh, and I think they will gradually become more comfortable with it. And a very important, and maybe even the most important component, is someone that we don't talk about usually, but it's actually the lenders of these buildings. So the people who give the mortgages to the buildings, they're very uncomfortable with anything that doesn't look like a plain vanilla building full of like very normal people signing leases. So I think part of what the landlords are doing with those new partnerships is they're kind of acclimatizing their lenders to the fact that, okay, we can have those other types of tenants under a different model, and it's actually okay. They still pay the rent, the building is still stable. And I think as the lenders become more and more comfortable with it, it'll be easier to finance more of these projects, and for the co-living model to move into more and more institutional types of assets like the ones that Greystar is operating. And I think it would also make life easier for the co-living companies, even when they work on their own, because then instead of having to buy a building or rent a building with money from venture capital investors that they don't charge you, but they expect a much higher return, they could just go to the bank and say, hey, there's a great building here. Give me 80% of the money that is needed in order to buy it, because I'm just a normal company now. Don't look at me like I'm crazy. I've done all these things already. They work, and it's a common model now. So yeah, so
That's
hopefully
perfect.
soon.
Yeah. And maybe that's a chapter in your book. Like, what would you say again? Like, again, a little
Mhm.
bit more of that VC conversation,
Yeah,
like the path to profitability. If
yeah.
somebody's listening or watching this show
Hmm.
and they're thinking about getting in this industry and they think, oh, do I need to raise a bunch of venture capital money? Do I
Hmm.
need to go to the bank and try to just buy the building on my own and
Yeah.
operate it as co-living? Like, how would you say that your expert opinion on the path to profitability and a good way to kind of dip your toe in?
I think the kind of the capital stack of a co-living company should be a mix of a few different things. I think it's okay to rely on venture capital in order to, develop some technology, which usually doesn't mean, again, reinventing the wheel. It's more about taking existing things and just integrating them, making them relevant for your customers, spending some money on building the brand and building the digital kind of storefront or distribution channel. But then for most of the inventory itself, it's better to rely on other sources of funds. So again, like Star City, like Common is doing now, uh, going to investors that are real estate investors, raising a separate fund that is a real estate fund, or partnering with an existing fund in order to buy buildings for you or sign leases for you. And then as this model becomes more and more kind of recognized and doesn't seem so exotic and scary, to start even relying on the banks themselves. So both for mortgages for the building, but also just for business loans for the business itself, to finance the fact that you have to buy furniture inventory or stuff like that, or other parts of your operation, to just rely on capital that is easily and cheaply available to any normal business. And again, basically, the, the short answer is to use as little venture capital as possible, but definitely use it, because it is important in the beginning to kickstart these kind of companies, because you can't go to a bank and say, hey, I have this crazy new idea, give me the money to buy a building. But after you've done it for the few buildings, you can start building that
Or they
relationship
or
with the
you're
bank.
right, they let you do like 20%. Like, okay,
Yeah.
20% of your building can be co-living,
Yeah.
80% has to be regular.
Hmm.
Okay, so that's kind of still that trend. What about,
Hmm.
you mentioned mortgage companies, and I
Yeah.
keep telling my mortgage friends, fractional ownership. Like, what are
Yeah.
your thoughts? Do you see that in the near future?
So I know a lot of people are experimenting with it. It's definitely interesting. What I struggle with is, the problem today in the residential market is that people that buy homes basically park 100% or 150% of their net worth inside a single asset. Now, once people are able to park that, to diversify that position, and to invest in real estate more easily, uh, I don't know if they would want to own a piece of where they live. They might choose to own pieces of a lot of other things that are just attractive as an investment, but not attractive as a place to live. Today I live in Brooklyn. I invest in other parts of the world. The apartment that I live in, I rent because I wouldn't, like, it's probably not worthwhile to buy it because the return on it, my money is happier in other places so far. So I think it's interesting, but it's more interesting as a way for people to generally diversify their investment in real estate. I don't think that people, if you allow them to spend $1,000 and buy a small piece of an apartment, they don't necessarily need to buy the apartment that they're in, and they're probably better off buying a small piece of something else. But it is interesting. We'll see more of it, but I don't see it as something transformational over the next few years.
Okay, and so what would be transformational? So my last question for you, and
Yeah,
thanks again so much for coming on.
sure.
At 10 years out, we
Yeah.
fast forward 10 years,
Mhm.
where do you see co-living?
On Mars, of course. But
That by then, wasn't that 2032, I think?
yeah, I
We have a
think,
couple more years.
yeah, I think, and the Cybertruck, Elon Musk's
Well,
Cybertruck, will
that,
help
yeah,
you
for
move,
sure.
and yeah, it will be autonomous. But where do I see it? I think some of the leading companies in the space, I think, will have a portfolio of different brands that are focused on different types of people. So, whether it's empty nesters or young families or divorced dads with kids, or like all sorts of kind of exotic combinations that need specific layouts or specific services. And I think we will see the maturation of that capital stack. There will be very standard ways of financing each type of activity. So, who are the investors and the lenders to your technology kind of layer, who are the investors and lenders to the real estate layer, and maybe a few other things below that, which again is common in the hotel world. So, a Marriott building, Marriott is a publicly listed company. There's certain investors that want to invest in that company, just like there are investors that buy Starbucks shares or, any other asset, any other company that uses real estate but is not really a real estate company. And then there are separate real estate investment trusts that own a lot of the actual buildings that Marriott operates. And they're very big in themselves, but they're not as famous to people that don't invest because, they don't have their name on the building. And the people who buy shares in those companies are very different people from those who would buy shares maybe in a Marriott. They're people that are looking for very stable income, that want the kind of collateral of the real estate itself behind the business, and not just kind of something that goes up and down with the seasons. So yeah, in 10 years, we're definitely going to see kind of a very clear capital stack for co-living and a bunch of brands. And I think most importantly, we're just not going to see a thing called co-living anymore. It will just be called apartments or living or something. And and buildings will have a bit of everything. You could stay for the night, you can bring in your guests and have a unit for them. You can stay for 6 months, you can stay for 3 years. You can add rooms and take them out. Just a more liquid and more pleasant world.
See, Rethinking Real
Yeah.
Estate. That is the perfect title for your book. And so you're an incredible writer. I can't wait. I know you were sweet enough to mail me a copy, so it's probably in my mailbox. I've been too busy to check, but I can't wait to dive in because again, just your posts online, I love.
Thank you.
Thinking about how to reinvent real estate and think about the future. And so we will have your website information. You're also an incredible public speaker. If anybody is looking for a speaker to talk about this exact topic. So thanks for coming on.
It's been a pleasure, Christine. Thank you, and see you again soon.
Yes, we're going to talk technology next time, so we will bring you on. And today is New Year's Day, so this episode is filmed for New Year's Day, the perfect start to 2020.
See you soon.
Okay, bye-bye.
Bye-bye.
Thank you so much for checking out today's episode. If you want to learn more about co-living, you could check out my book on Amazon, The Co-Living Code. And of course, if you're looking for the perfect software to power your co-living concept, check out kindred.io, KNDRD.io. Thanks. And a quick thank you to SPX Agency for all of the graphics, animation, and design on our YouTube channel.